Hey there, welcome to the next lesson in my course on creating 5-year financial models in Excel. If you haven't seen the previous videos, you can find links to them in the description below. And if you want to download the Excel files and follow along, you can do so on the first link in the description below. Now let's get back to Excel.
In the previous section, we built our corporate tab, which has our holding company and the forecast for the next 5 years. Now that we're done with this tab, let's mark it green. Probably go ahead and somewhere down here in the change log, say finalized corporate model. Just go ahead and make sure all those are aligned. Okay, what we want to do is we want to reuse this as much as possible and start building the models for the other entities. I'm just going to right click, create a copy. And this copy, I'm gonna call it def, and this is gonna be my Minty def model. And the first thing we wanna do is we wanna go ahead and replace all the blue numbers, the historicals and the income statement, balance sheet, and cash flow statement. Just gonna move this Minty def right next to my def tab, so it's easier to copy and replace everything. So I'm just gonna bring the revenue here. Then I hope that this is the same format. Let's see. Yep, it looks like it is. Going down, I'll need those three. Depreciation and so on and so forth. And my taxes as well. Going down, I have cash and cash equivalents, accounts receivable, intercompany, inventory, PPE. I have 5 rows here and I have a bit more here. But the other 2 that I have here are goodwill and investments, and they're at the bottom. So I can just copy those 5. Paste them here and make sure that all those here below are 0. Control Enter to fill the whole thing. Then accounts payable, intercompany payables, and debt. 3 here, and I don't have the other liabilities, so those remain 0. And I also need my equity capital and my retained earnings down here. For the cash flow statement, have those 4. And I pasted them in the wrong place. So those 4 coming up here. And down here, I only have investment in property and dividend payments. So investment in property is my first one. I'm gonna grab this one, paste it here. This will be 0. And I have some dividends payments, which correspond to the dividends income that I had in the corporate entity. Paste those here. I don't have any debt or equity. And I have a starting cash balance I'm gonna put in here. Okay. You see that everything here evens out, and here we have some issue with the balance sheet, and by the look of it, I think it's the debt is a part of it. Now that we have all the historical financials from Minty def, we can just bring that back here and start fixing the assumptions from the top. So the first thing we need to change is here we have revenue. So now we're going to switch from calculating our expenses based on a growing total operating expenses, and we're going to switch from that to calculating them based on percentages of revenue. Here we'll have revenue. It's a growth percentage, and this will be percentage of revenue. Copy that to the bottom. This will also be percentage of revenue, and this is going to be a percentage of pre-tax income. First thing we need to do is we need to adjust this to be the growth in our revenue. revenue in 21 divided over revenue in 20 minus 1. Copy that to the side. That's it. So we grew quite fast, but let's assume that we're going to have a same-store growth, 5% going forward, and all the rest will come from the new product that we're launching, and all this uplift will be calculated in a separate tab, so we will retain the capability of switching on and off whether we have this new product or not. I'm going to leave that at 5%, and let's go down in the income statement and adjust our revenue. So we're going to calculate this as the prior period revenue multiplied by 1 plus our growth percentage from up here. And we can copy that to the side. Then we need to calculate cost of sales. For the purpose of that, let's just add another line here, name it cost of sales. And this is also going to be a percentage of revenue. And let's calculate the average percentage that it used to be. So we're grabbing cost of sales and dividing that over revenue. Format that as a percentage. Copy it to the side. And then let's grab one of the moving averages and place it here, as we want to keep having a similar percentage of cost of sales. Let's go ahead and calculate our cost of sales in the income statement. So this is going to be equal to our revenue multiplied by the percentage that cost of sales is from revenue for this year. Copy this to the side with Control R, and we have our revenue and cost of sales. Next thing we need to do is all those are calculated based on total operating expenses. So let's switch that. Just want to press F2 to edit the formula, and you can see that it's the salaries and benefits over the total operating expenses. Just gonna grab that and move it to revenue. It's still fixed for the row, so I can copy it down and it would still link to revenue. Copy that to the side and copy it down. Gonna leave all those as moving averages, and then also need to switch that so it's not from total operating expenses but from revenue as well. Copy that to the side with Control R. Switch this one as well to revenue. Copy that to the side, and I'm actually gonna switch that to moving average as well. And my pre-tax income is calculated correctly, and I'm gonna leave it at 35%. Now let's relink all the expenses and fix total operating expenses here. So those expenses will all be equal to the respective percentage multiplied by the revenue for the period. And I'm gonna fix that with F4, tapping it twice to only fix the row. Now copy it to the side and Control D to copy it down. What I can do next is make sure that this is no longer a growth calculation, but the sum by carrying this formula over. And now I have my EBITDA calculated down here based on a growing revenue with a specific assumption percentage and averaging the expenses to be the same portion of revenue that they used to be. Next, the depreciation and amortization is again a percentage. So I'm gonna grab the percentage of revenue from here and multiply it by my revenue. I'm gonna fix that with F4, so just the row is fixed. Copy that to the side, and I'm also gonna copy it for other non-operating income. My taxes should be calculated correctly, linking to the percentage here, and my interest is still coming from my debt schedule. So it's linked properly. And you probably notice that there's no interest in the previous periods. And if you come to the balance sheet, there's no debt. If we look at our summary, there's no debt for Minty Dev. Let's go ahead and clear our debt schedule. What we need to do is just make sure that this is zero, the principal starting balance, and we don't have anything here in terms of debt amortization or interest expense. And because this is linked in our statements, it's now going to be fixed everywhere. Just ignore this error because it's a different formula than the other two. You see that really quickly we repurposed the model that we already built, and in just a matter of minutes, we have our income statement modeled going forward. Now let's go ahead and see what's happening with the balance sheet. If we come up here, so we fixed our income statement drivers, we fixed our debt schedule, and our accounts receivable, inventory, and accounts payable. If we build them correctly in the previous model, they should work straight out of the box. So we see the days here, and you see that the inventory days is like extraordinarily high. And the only explanation that I can come up with for that, apart from this being a dummy set of data, is that there's some businesses, for example, telecoms that provide TV, and you know those TV boxes, those have a really long shelf life because they reuse them. They sometimes sit in their warehouses for years because they rarely get updated. This can be something similar, so it's not alarming to see such a huge number for inventory days. The only thing that you should make sure to do in such cases is just make sure that you look through the formulas again and make sure that you didn't mess something in terms of the formulas here. If we go down to the property, plant, and equipment, this is all set up. Just gonna leave it with the same assumption that we're pretty much doing enough CapEx to cover depreciation, which means that the company is staying within the realms of the same PPE. There's no goodwill. Our equity schedule and our retained earnings schedule are already linked. We're not issuing any equity, and we don't plan to do any additional dividend payments, at least for now. So our income statement is relinked, our balance sheet, everything is linked and drawing out in the check, and our cash flow statement is matching everything. In a matter of minutes, we took the model that we built, and we now have a fully functioning 5-year financial model for a Minty Dev entity. So now let's go ahead and grab Minty Pipeline. And to do that, I'm just gonna right click and copy the dev model. And the reason I'm choosing to copy the Minty Dev model is that we changed it and we adjusted it so that all the income statement elements are based off of revenue instead of total operating expenses as it was with the corporate model. Just gonna grab that, create a copy, and just rename it to Pipeline. Rename it up here as well. I'm gonna add in my changelog that I built the dev model, say 9722, and just to mention this again, this should be more detailed. Well, it should be whatever you need it to be, but usually when I'm working on model for a client, I would have like 200-300 rows here with different things that I change, especially when I change logic. If let's say we're calculating depreciation and CapEx as matching each other, and I switch that to having a dedicated CapEx plan and this influencing my depreciation calculation, I'll definitely have that in here. Let's go ahead and start adjusting our pipeline model. I'm gonna grab the pipeline source data and just move it here so I can start copy pasting my historicals. And sometimes it might make sense to like link those with formulas or use a VLOOKUP to grab them, but I would usually prefer to have them as numbers within the model just to make sure that they're historicals and it's evident that they're actual numbers, that they're not gonna change. Also, usually when I'm sharing the file afterwards, I would share it without this sources section here because this might include more data than I'm actually using for the model, and I don't want to share this additional data with other stakeholders because I don't want to confuse them. Let's paste that over here. here, grab the expenses, place them here, grab the non-operating ones over here, and grab the tax over here, and the assets with those 5, and those 2 again remain 0. And I'm not removing those from here, and I didn't remove them from the def model. And the idea for that is that I want the 3 statements to be exactly the same for each model that I built. This will make our life much easier when we aggregate and consolidate further down the line. Go ahead, grab the accounts payable, intercompany payables, and debt. You see this one has debt, so we'll need to adjust our debt schedule. And grab this here for the cash flow statement. So we have our investments in property, and we have our dividend payments. And we also have some debt-related items here. And our starting cash is 13.5 million. This all balances, and we need to figure out why the differences come up in the balance sheet, and I'm pretty sure this is going to be our debt schedule. Just bring that back here in the sources. And now let's go over the assumptions and make sure to adjust everything. So the revenue growth percentage, we're going to leave it the same. It's the concept of same store growth that we mentioned earlier. And the whole idea here is that we assume our core business, and our core business are the 3 revenue generating entities without the holding, without the corp, which takes care of like new products, acquisitions, etc. We assume that those are going to grow at a steady 5% rate, and all revenue uplift and margin uplift is going to come from additional acquisitions and the launch of our Minty Tools product. So going down, everything here should be linked, and taxes are at 35%, and we have debt here. If you take a look at the debt summary, they took 52 million, the same time that the holding took 150 million, but the only difference is that this is for 7 years. So let's adjust this to 7 and have this be 52,000, and it's linking to the proper opening balance in 23. You see some num errors here, and the reason for that is that it only goes up to 7 years, and then it's an error. And the way to fix that is we can just wrap those with an if error formula. I'm actually gonna paste it over the whole column, and here as well, if error, give me 0. And Control D to paste this down. Doesn't change anything apart from making it look cleaner. If we go down, our cash conversion cycle is already linked up. You can see that here inventory is even more absurd. 700 days. Payables is closer to what we saw in the corporate model. And once again, this is all based off of dummy data that I've prepared. Not that it's impossible to see that in real life, but if you calculate your cash conversion cycle and you end up with some weird looking numbers, then definitely double check your calculations. Going down, PP, we're gonna follow the same logic, keeping the same balance by matching CapEx to depreciation. There's no goodwill, and for equity schedule, no issued equity and no dividend payments. If we go down, this is all linked, it calculates, and you can see that we are generating loss because we're paying a lot of interest, but as it goes down, we start to break even and even get a bit above. Going down, our assets are all linked, our debt is linked and being repaid by 26. Let's see if that's the case. I'm not sure if this is linked correctly. So if we go up to our debt schedule, we'll see that, by the end of 26, we don't have any more debt. so it's linked correctly. Going down, we can see that it zeroes out the assets versus liabilities and equity check. Our cash flow statement is all linked and our checks here are fine. Actually gonna grab those and remove this highlight. I don't know why I left it from the start, and to be consistent, I'm gonna remove it in all instances of the model that we have so far. Once again, in just a few minutes, we're able to grab the same model, bring back the debt assumptions for the specific entity, and we now have our strategic outlook for the next 5 years for the Minty pipeline entity. Let's just make sure that we have that in our changelog. And let's go ahead and create a copy of it that we can use for our Minty solids. Create a copy, solids. Okay, I'm gonna grab the solid source and bring it all the way here so it's easier to transfer data. And let's go ahead and repaste the financials. Revenue and cost of sales, all the expenses as well. Depreciation and amortization, interest and other non-operating, and the taxes. And for assets, grab those 5, paste them here. The other 2 remain zeros. Accounts payable, and our equity section as well. Okay, those zeroed out. There's some issue here, and that's probably the debt. Go down. We only have investment in property, plant, and equipment here. All the rest remains zeros. And we don't have any debt or equity. And the starting cash is 6.9 million. Okay, those evened out. Here we have some issue, probably with the debt. Now let's go ahead and review the assumptions here. We're gonna leave the revenue growth the same. All the rest are moving averages once again, and taxes at 35%. But we don't have debt in this entity. Just gonna switch that to 0, and all the debt is gone. Our cash conversion cycle is calculated on its own. Once again, we have some absurd inventory days here and quite high accounts payable days. Going down, property, plant, and equipment, we're gonna follow the same approach. There's no goodwill, no issued equity or dividend payments planned. Everything should be in order. So we have our income statement here. There's no interest. Tax is calculated. Our assets, liabilities, there's no debt. Everything matches in the balance sheet and everything matches in the cash flow statement. And that's it. Once again, in just a couple of minutes, we created the whole 5-year strategic financial plan for the Minty Solids entity. And next video, it's going to get a bit more interesting because we're going to look at the rock code acquisition, and there we'll need to add additional features within our assumptions section to make sure that we are taking care of all the additional details that come along with rock code being an acquisition. Thank you for watching another part of the course. As soon as the next video is uploaded, you'll find it right here. By the way, if you can spare a minute, I would love to hear your thoughts on the course and whether it's living up to your expectations. If you're watching on the website, you can do so by the feedback button up there. And if you're watching on YouTube, just drop a comment down below. Thank you.